January 19th, 2008, Paris, France, Société Générale's risk team discovers something impossible. A junior trader named Jerome Kerviel has accumulated secret positions worth 50 billion euros, more than the entire bank's market capitalization. He's been hiding these trades for over a year, using fake hedges and falsified documents. And when they unwind his positions over 3 days, the bank loses 6.7 billion euros, the largest rogue trading loss in history, nearly destroying France's second-largest bank, all because one 31-year-old trader decided rules didn't apply to him. This is the story of how one junior trader accumulated positions 50 times larger than his limit without anyone noticing, how he used knowledge of the bank's systems to create fake trades that made his bets invisible, how his positions grew to 50 billion euros larger than Kenya's GDP, and how the bank lost 6.7 billion, closing everything in 3 days. If you want to understand how rogue traders exploit bank weaknesses, how unlimited risk-taking destroys institutions, and why sophisticated banks can be fooled by one person who understands their blind spots, hit subscribe and comment which city you're watching from, because what happened at Société Générale in January 2008 revealed that banking's biggest risk isn't market crashes, it's internal fraud that goes undetected until losses become catastrophic. Jerome Kerviel joins Société Générale in 2000. He's 23, son of a hairdresser and metalworker from Brittany, studied finance at University of Lyon. Not elite, not connected, but smart and ambitious. He starts in compliance and risk management, the back office, processing trades, checking positions, making sure traders follow rules. And this is where he learns everything: how the bank's systems work, what controls exist, where the gaps are, what documentation gets checked, and what gets ignored. He's learning how to beat the system by working inside it. 2005, Kerviel moves to the trading desk, Delta 1 division, trading index futures and equity swaps. His authorized limit is 125 million euros maximum position. His profit target is 55 million for the entire desk annually. Small numbers. This is a support division, not a profit center, but Kerviel has bigger plans. He starts making unauthorized trades, small at first, then he discovers something crucial. The bank's risk systems catch traders who exceed limits, but not traders who create fake offsetting positions. So when he buys 10 million in DAX futures betting German markets rise, he enters a fake sell order for 10 million, showing he's hedged, net position 0. But the fake order is designed to fail settlement, wrong dates or counterparties, so it never executes but sits in the system, making his real position invisible. This works because risk systems check net positions daily. If you're long 10 and short 10, net is 0. No risk, no flags. The fake trades should be caught during settlement, but Kerviel knows from back-office experience that settlement teams only investigate when counterparties complain. His fake trades fail quietly without alerts. Nobody investigates. He's created a perfect blind spot, unlimited positions, as long as he creates fake hedges. 2006 through 7, positions grow massively. No longer 125 million, now billions, tens of billions. Simple directional bets on European indices. When markets rise, he's long. When they fall, he's short, and he's making money. By end of 2007, he generated 55 million in profit, exactly the desk target, except he did it alone through unauthorized trading. His bosses are thrilled. They don't ask how a junior trader generates these profits. Don't investigate why his results exceed everyone else. They just see money and celebrate. But what they don't see is positions worth 50 billion euros by December 2007, 30 billion over his 125 million limit, larger than the bank's market cap, enough that a 5% move generates 2.5 billion profit or loss. Completely hidden behind fake hedges showing net position near 0, the bank thinks he's running boring arbitrage with minimal risk. Reality is, he's making the biggest directional bets in bank history. January 2008, markets crack, subprime crisis spreading, Bear Stearns hedge funds collapsed July, Northern Rock failed September, credit frozen, equity markets volatile, and Kerviel's massive long positions, his bets that European markets rise, are losing money, big money. He can't hide losses forever. Fake hedges work when nobody looks closely, but large losses trigger investigation. He's trapped, needs markets to rally to reach break-even, but markets keep falling. Losses keep growing. January 11 through 18, risk teams notice anomalies, trades that don't match, confirmations never arriving, counterparties that don't exist. They ask Kerviel questions. Why is this trade 3 months old still pending? Who is this counterparty? Where are confirmations? Kerviel buys time, says documentation coming, back office errors. He'll fix it, but risk teams keep digging. January 18. They discover truth. They calculate actual net position, not zero. 50 billion euros long European markets, and markets falling means losses are catastrophic. January 19th, Saturday morning, executives called to emergency meetings. Risk team presents impossible findings. Jerome Kerviel accumulated 50 billion euros unauthorized. Current losses 4.9 billion. This could destroy the bank. Société's market cap only 43 billion. Loss this size wipes out shareholder value, and if markets keep falling, losses grow larger, potentially forcing bankruptcy or bailout. Executives face immediate decision, hold positions hoping markets rally, potentially recovering losses, or close everything immediately, taking certain loss but eliminating risk of larger losses. Complicated. Because it's Saturday, markets closed. They have the weekend to decide. European markets open Monday. They need speed and secrecy because if word leaks about rogue trader with massive positions, other traders front-run them, shorting knowing SocGen must sell, making losses worse. Sunday, January 20th, board decides, unwind everything, close all positions fast as possible, take losses, eliminate risk. They cannot hold and hope. Survival at stake. Plan is sell Monday when Europe opens. Dump billions in futures and swaps quietly as possible, but selling 50 billion quietly is nearly impossible. One of largest liquidations in history, markets will notice. Monday, January 21st, Europe opens. Société Générale starts selling, dumping DAX futures. Euro stocks, massive blocks, markets immediately fall. Traders see selling size and panic. Rumors spread major institution in trouble. Hedge funds short into selling. Momentum traders pile on. European markets crash. DAX drops 3.7%. Euro stocks 4%. Biggest drop in months, and SocGen still selling, only unwound portion of Kerviel's positions, must continue Tuesday, Wednesday. Tuesday 22nd, markets open lower. SocGen continues selling more billions, hitting markets, global panic spreading, Asian markets close down overnight. US futures plunging. Dow opens down 300, VIX spikes to 30 traders, asking who's selling this much, what institution in trouble. But Société Générale hasn't announced, trying to complete liquidation before going public, keep dumping even as markets crater because no choice. Wednesday 23rd. Liquidation complete, all Kerviel positions closed. Final tally, devastating 6.7 billion euros, lost over 3 days, largest rogue trading loss in history, larger than Nick Leeson's 1.3 billion destroying bearings in 95, larger than Rusnak's 691 million. At Allied Irish in 2002, record-breaking disaster now must announce to world. Thursday 24th press conference, CEO Daniel Bouton and Chairman Philippe Citerne admit junior trader created 50 billion unauthorized, resulting in 6.7 billion loss, explained Kerviel exceeded authority. Falsified documents created fake trades, hid from supervisors, claim rogue actor systems sophisticated, but he exploited gaps. Management had no knowledge until January 18th, announced firing and criminal charges. Reaction immediate and brutal. SocGen stock crashes 20% one day, wiping 8 billion market value. French government scrambling to determine if bank needs support. European banks distancing themselves, claiming better controls. Global media running headlines about 31-year-old nearly destroying 150-year-old bank. Questions damning. How did this happen? Where were risk managers, supervisors? How can junior trader hide 50 billion for over a year? Authorities launch investigations. French banking regulator, ECB, prosecutors, everyone wants answers. What they find is systemic failure at every level. Supervisors never questioned outsized profits. Risk managers checked reports showing fake hedges, but never verified hedges were real. Compliance never investigated why trades failed settlement. Back office never escalated anomalies. Senior management never asked how 125 million limit trader generated 55 million profits. Entire control system failed because everyone assumed someone else was watching. Kerviel arrested January 26, charged with breach of trust, forgery, unauthorized computer use. His defense is interesting. Claims not acting alone. Supervisors knew about unauthorized trading because profits obviously came from positions far larger than limit. Claims bank only cared about profits and ignored risk until losses appeared. And there's truth to this. Hard to believe junior trader generating 55 million didn't raise questions. But whether supervisors explicitly knew or willfully ignored, result is same. Société Générale lost 6.7 billion and nearly failed. The disaster reveals fundamental problems in bank risk management. First, position limits are meaningless if you don't verify positions are actually within limits. SocGen had sophisticated reports showing Kerviel's net near zero, but reports relied on data, including fake hedges. Nobody verified offsetting trades were real, just checked net numbers looked reasonable. This is compliance theater versus actual risk management, checking boxes versus reality. Second, profit anomalies should trigger investigation, not celebration. When Kerviel generated 55 million, same as entire desk target, while others generated much less, that should raise red flags immediately. Outsized profits relative to limits and peers almost always means outsized risk, hidden or unauthorized. But management saw profits and asked no questions. Happy to have star performer didn't want to look closely at how this is how rogue trading always works. Traders hide risk while winning. Management ignores red flags because money flows. Then markets turn, losses appear. Everyone claims no idea. Third, people who understand control systems intimately are biggest internal fraud risk. Kerviel worked back office 5 years before trading knew exactly how settlement worked, what risk managers checked, where gaps were used. That knowledge to design fake trades, slipping through undetected banks. Need to understand former back office employees moving to trading have knowledge enabling sophisticated fraud. Not that they will commit fraud, but if they choose to, they know how. Requires extra scrutiny, controls, verification. Fourth, repeatedly failed settlements should trigger immediate investigation. Kerviel's fake hedges designed to fail. Wrong dates, counterparties, details, sat in settlement queues, weeks or months showing pending. Operations saw failures but didn't escalate as suspicious. Assumed administrative errors, but repeated failures from same trader should be treated as fraud indicators, exactly what they were. Red flags waving, nobody looked at. Fifth, technology alone doesn't prevent fraud. Société Générale had sophisticated systems, automated monitoring, compliance software, all expected technology. But none detected Kerviel, because he understood systems and designed fraud exploiting their assumptions. Risk systems assume trade data is accurate, check positions within limits based on data. But if data itself is fake, systems pass fake through. Human judgment, verification, skepticism cannot be replaced by algorithms. Criminal trial begins June 2010. Kerviel faces 5 years prison and unlimited fines. Defense strategy blames Société Générale, argues supervisors knew he took large unauthorized positions because profits made it obvious, argues bank tolerated behavior when making money and scapegoated him when losses appeared, argues he followed bank culture encouraging risk-taking and ignoring rules when profits flowed, presents evidence other traders exceeded limits without consequences. Emails to supervisors mentioned large positions. Bosses must have known. Prosecution argues Kerviel acted alone, deliberately deceived employer through falsified documents. And fake trades exceeded authority by astronomical amounts. 50 billion versus 125 million is 400 times over, regardless whether supervisors should have detected sooner. He knew he broke rules and chose to anyway. Legal question is whether Kerviel is criminal, who defrauded employer or scapegoat, taking blame for systemic failures management should have prevented. October 2010. Verdict: Kerviel guilty all charges, sentenced 5 years prison with 2 suspended, ordered to pay 6.7 billion restitution to Société Générale, full loss amount, banned from finance. Judgment holds regardless of management failures. Kerviel deliberately exceeded authority and caused catastrophic losses through fraud. But restitution symbolic. Kerviel can't pay billions, will pay nothing. Sentence about accountability, not compensation. Kerviel appeals, legal battle continues years. Writes books claiming innocence, becomes folk hero in France among those seeing him as symbol of banks, blaming individuals for institutional failures. 2016 serves prison time, 117 days before release. Restitution reduced to 1 million, tiny fraction acknowledging making him personally liable for bank losses was absurd. By 2024, working as IT consultant, prohibited from finance, still claiming bank knew. Société Générale survives barely, 6.7 billion loss, devastating. But bank raises capital, cuts costs, fires senior management, implements new controls, rebuilds. CEO Boutin resigns in shame. Risk management completely restructured, limits verified manually, not just automatically. Settlement failures trigger immediate investigation, spends hundreds of millions upgrading systems. But reputational damage lasts years. Clients leave, shareholders sue, regulators impose fines. Soc Gen goes from France's premier investment bank to being seen as incompetent and risky. Industry learns lessons or claims to. Every major bank reviews rogue trader controls after Kerviel, implements new verification, trains staff on fraud indicators, but fundamental problem remains. Banks are complex with thousands of employees and millions of daily transactions. Determined insiders understanding systems can always find ways to hide risk as long as culture prioritizes profits over controls. Management celebrates outsized returns without asking how they're generated. Warning signs ignored because money flows. Rogue traders keep appearing. Banks keep losing billions. Here's what matters. Société Générale had every system needed to detect Kerviel, but didn't use them properly because management was blinded by profits. When someone makes money, nobody asks questions, verifies, investigates anomalies. That willful blindness enables fraud. Subscribe now if you want to understand how internal fraud destroys institutions, how sophisticated systems fail when culture is broken, and why the next Kerviel is probably hiding risk somewhere right now in a bank thinking their controls are bulletproof. Share this with someone in finance. Because what happened at Société Générale is the template for every rogue trader disaster. Someone exploits blind spots. Management ignores warnings because profits are good. Losses appear. Everyone claims no idea. Pattern repeats because banks learn nothing.